Welcome back to the Daily Hunt for Multibaggers, your go-to podcast for AI-generated market commentary and speculative analysis. It's Thursday, October 23rd, 2025, and we're looking at all the buzz from yesterday, October 22nd. Our AI flagged quite a few stocks today, showing a very mixed sentiment across social media discussions, some highly optimistic, others deeply skeptical.
Indeed, Ethan. We saw a high volume of posts covering many different companies. While there's a lot of speculative bullishness, particularly around some high volatility names, the underlying financial metrics for many of these companies suggest a good deal of caution is warranted.
All right, let's jump right in with Tesla, TSLA. Social media was buzzing with a lot of talk about their Q3 earnings. There were some predicting a bloodbath, but also some looking at that revenue beat, saying, hey, maybe this is just short-term noise, with Elon's robo-taxi vision still a big long-term play. It even had a speculative gamble rating from us just a few days ago.
Well, Ethan, while the Q3 sales did show a revenue rise, the reality is quite different. The company missed earnings estimates and operating income was down a sharp 40% year over year. That's a significant hit to profitability, and those KPIs are screaming overvalued. Its price-to-earnings ratio is an astonishing 262, and its revenue growth is actually negative at negative 0.118. That's a fundamental disconnect from its stock price. Our previous stay-away ratings, they're reinforced.
So, despite any flashes of growth potential,
Stay away from TSLA. The fundamentals just don't support the valuation.
next up, Applied Digital, APLD. Now this one had some exciting news. A $5 billion AI factory lease with an investment-grade hyperscaler. That's massive. B. Riley even raised their price target to $47. This company has shown impressive year-to-date gains, suggesting real growth.
That sounds great on paper, Ethan, but the market reaction was telling. The stock actually dropped 10% after that announcement. Users were quick to point out that the news might have been priced in, and some even hinted that the lease was secured more out of loan purposes than purely organic expansion. With a beta of 6.592, this stock is exceptionally volatile, and its net profit margin is a negative 1.41. It's losing money, big money, and carries a high debt-to-equity ratio. It's still a stay away from our previous ratings.
So, a big announcement doesn't always translate, huh?
No, it certainly doesn't. My verdict for APLD is stay away.
Moving on to Intel, INTC. There's a lot of bullish sentiment here, talking about government backing, crucial strategic partnerships with big names like NVIDIA, and even rumors of OpenAI involvement. Users are calling it too big to fail and projecting aggressive price targets.
Yes, but let's ground that optimism, shall we? While the narrative is strong, the financial KPIs tell a different story. Intel's net profit margin is a negative 0.38, and its earnings per share is negative 4.77. The revenue growth is near zero. Wedbush analysts even described its valuation as unsustainably rich, with a target price significantly lower than current levels. This is another stay away, consistent with all its prior ratings.
So the big picture isn't matching the numbers just yet.
Precisely. For INTC, it's a stay away.
Okay, now we can't talk about market buzz without bringing up Beyond Meat, BYND. This stock has been on an absolute roller coaster, with discussions of gamma squeezes, meme-style rallies, and some incredible short-term gains. Some users were absolutely ecstatic, seeing it as a vote of confidence in alternative proteins.
And a lot of YOLOs, Ethan, which screams high speculation. But let's look past the hype. This company's financials are in severe distress. Negative revenue growth, a deeply negative net profit margin of 0.5, and an EPS of negative 2.14. The most alarming metric, in my opinion, is its price-to-book ratio, which is also negative, indicating liabilities exceeding assets. Analysts are warning of an 80% crash, and we've seen massive share dilution. Our stay-away rating from yesterday, and frankly all previous mentions, holds true.
So all that excitement, it's just a facade.
It's certainly not based on a sound business. BYND is a stay away.
Next up, QuantumScape, QS. Users are expressing strong belief in their solid-state battery technology, citing recent B1 sample shipments as a key milestone and a narrowing of Q3 losses. There's a lot of long-term vision being discussed, seeing potential for substantial gains.
I appreciate the vision, Ethan, but QS is still very much a speculative play. It's currently unprofitable with negative EPS and zero net profit margin. Its beta is an extremely high 4.859, meaning it's incredibly volatile. Plus, it carries a high debt-to-equity ratio. While the tech is promising, the company is still burning capital and profitability is a distant prospect. It remains a stay away for us, mirroring its last rating.
So, still in the future potential bucket, not quite present value.
Exactly. For QS, it's a stay away.
Let's discuss Robinhood, HOOD. User sentiment is notably bullish, with some even predicting it could hit $200 by year-end and $400 by 2026. It's seen a massive run-up from its 52-week low and has positive revenue growth and a strong net profit margin.
While the past performance is impressive, Ethan, we have to look at current valuation and risk. Its price-to-earnings ratio is 64.57, which is very high, suggesting significant future growth is already priced in. And with a beta of 2.43, it's extremely volatile. The current price is already quite high, limiting easy upside for new investments. Our previous stay away is reiterated.
So, the gains might be harder to come by now.
Substantially harder, with more inherent risk. My verdict for HOD is stay away.
Moving on to AMC Entertainment, AMC. The technical charts are looking good for the apes here. It's broken out of a clear downtrend channel, showing bullish engulfing candles, and even rallied on a day when the broader market was down. The sentiment is that it's poised for a recovery.
Technicals can be compelling, Ethan, but fundamentals are non-negotiable for us, Ethan. AMC remains unprofitable with a negative net profit margin and a negative earnings per share. Even more concerning, its price-to-book ratio is negative, implying that its liabilities exceed its assets. That's a significant red flag, regardless of short-term price movements. It's our first time rating it, and it has to be a stay away.
That's a tough pill to swallow for some.
For AMC, the verdict is stay away.
Next up, IBM. This one is confusing, folks. It actually beat Q3 earnings and revenue estimates and raised its sales forecast, yet the stock slid. Users are pointing to its long-term resilience and fundamental strength, with some predicting a return to 350. It's a stable name, pays a dividend.
And that's exactly where the caution comes in, Ethan. A stock sliding on good news indicates deeper market skepticism. Its price-to-earnings ratio is 34.22, which is quite high for a mature company with its 7.7% revenue growth. But the biggest concern is its extremely high debt-to-equity ratio of 245. That's a lot of leverage, increasing its risk profile significantly. We're downgrading it from its previous cautious buy to stay away.
So, good news just wasn't good enough.
Not with those underlying KPIs. For IBM, it's a stay away.
Last but not least, Krispy Kreme, DNUT. This is another name caught up in the meme rally. Users are expressing strong bullish sentiment, targeting $10 a share, and there's also news about global franchise expansion, which, could be great for growth.
A meme rally is exactly the right term, Ethan. The fundamentals here are concerning. DNU is deeply unprofitable with a negative net profit margin and an EPS of negative 2.65. Its revenue growth is also negative. To top it off, it has an exceptionally high debt-to-equity ratio of 199.33. While the global expansion sounds positive, it's not enough to offset such significant financial distress. It maintains its stay-away rating from yesterday.
So no sweet treats for investors here?
Not for the cautious ones. DNU is a stay away.
Sounds like no snacks for investors then.
No snacks for now.
Last but not least, Krispy Kreme, DNUT. This is another name caught up in the meme rally. Users are expressing strong bullish sentiment, targeting $10 a share, and there's also news about global franchise expansion, which, could be great for growth.
A meme rally is exactly the right term, Ethan. The fundamentals here are concerning. DNU is deeply unprofitable with a negative net profit margin and an EPS of negative 2.65. Its revenue growth is also negative. To top it off, it has an exceptionally high debt-to-equity ratio of 199.33. While the global expansion sounds positive, it's not enough to offset such significant financial distress. It maintains its stay-away rating from yesterday.
So, no sweet treats for investors here?
Not for the cautious ones. DNU is a stay-away.
Sounds like no snacks for investors then.
No snacks for now.
All right, that wraps up today's deep dive into the market. It was a day full of high-flying hopes and grounded realities.
A good reminder that speculation, while exciting, often clashes with fundamental financial health.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to the Daily Hunt for Multibaggers. We'll be back tomorrow with more AI-generated insights into the market.
Happy hunting!